Welcome to the Deep Dive. We're your shortcut to getting truly informed.
Glad to be here.
Today, we're diving into the U.S. stock market action from August 20th, 2025. It was, well, a really complex day with some surprising divergences.
Yeah, definitely not straightforward.
We've gone through a whole stack of financial reports, economic analyses, research papers, basically all the great stuff you share with us.
Lots to unpack there.
Right. And our mission today is pretty clear. Figure out what exactly happened, what forces were driving things, and, crucially, what it all means for you and your investments, both short and long term.
Let's get into it.
Okay, so let's peel back the layers on August 20th. The big headline. A clear split. You had the tech-heavy NASDAQ tumbling down 1.5%.
Significant drop.
And the broader S&P 500 lost ground to about 0.6%. But, and this is the twist, the Dow Jones Industrial Average, the old school industrial.
It actually held its ground.
Exactly. It eked out a tiny gain, 0.02%. So not a total washout.
And what's fascinating as you dig deeper is that it wasn't really a broad retreat. Our sources are calling it a great rotation.
A rotation, okay, meaning money moving around.
Precisely. Capital shifting sectors. And you see proof of that in the S&P 500 equal weight index, since it weights all companies equally.
Ah, so it gives a better sense of the average stock.
Right. And that index actually rose 0.45%. Plus, get this, 8 out of the 11 S&P 500 sectors finished the day positive.
8 out of 11, so the pain was really concentrated?
Very concentrated. Technology was the clear loser. We saw some big names, those mega caps, really get hit. Palantir was down, 9.4%?
Wow, nearly 10%.
And NVIDIA dropped 3.5% too. Big tech felt the pressure.
And adding fuel to that fire, there was that MIT report that came out.
Oh yeah, the one questioning the AI return.
Exactly. It stated something like 95% of companies aren't seeing meaningful returns on generative AI investments. That really threw cold water on the whole AI euphoria narrative, didn't it?
It certainly gave investors pause. It directly challenged the story that's been driving so much of the tech rally. A compounding factor for sure.
So while tech was down, where was the money going?
It flowed heavily into defensive, more value-oriented sectors. Real estate did really well, up 1.8%.
Strong move.
Utilities, always seen as a bit of a safe haven, rose over 1%. And consumer staples companies making things we buy every day climbed 1% as well.
A definite flight to, well, perceived safety or value.
Seems like it. A search for stability.
Okay, so we see the rotation. What was actually causing all this nervousness? What was the catalyst?
Well, the main thing hanging over the market was the anticipation for Fed Chair Powell's speech. Jackson Hole.
Ah, Jackson Hole. Always a big one. Everyone waiting for signals on interest rates.
Exactly. Huge focus on monetary policy direction. And the economic data wasn't helping clear things up.
Right. It was pretty mixed, wasn't it?
Very. On one hand, the Consumer Price Index, CPI, came in a bit cooler than expected. That might normally be good news for rates.
Okay, some relief there.
But then, the Producer Price Index, the PPI, which measures costs for businesses.
Yeah.
Well, that jumped way above estimates.
Oof. So that dashed hopes for rate cuts anytime soon.
Pretty much dimmed those hopes. Yeah, it just added to the uncertainty.
And you could see that uncertainty reflected in the VIX, right? The fear gauge?
Yep, the VIX climbed 3.9% to 15.57. So definitely elevated investor anxiety.
But there's a but here, isn't there?
There is. What's really interesting is that despite the higher VIX, analysts noted an extreme lack of downside hedging activity.
Meaning people weren't rushing to buy protection against a crash.
Exactly. It suggests that while investors were nervous, maybe it was more about, a strategic pause, a consolidation, rather than bracing for a massive downturn. Tactical, not terrified.
Okay. And then almost out of nowhere, this new factor from Washington emerged.
The Intel situation. Yeah, that's a big one.
The potential government policy shift, right?
Yeah.
Turning GPS Act grants for Intel into an equity stake. Like the government owning 10% of Intel.
Precisely. And this is really unprecedented territory for a company like Intel.
How does that fit into the bigger picture?
Well, it throws a wrench into things. It creates a lot of legal ambiguity. And it seems contradictory policy-wise, especially when they're also talking about new semiconductor tariffs, which could hurt companies. The GPS Act is meant to help.
So it signals a potential major shift in government intervention in key industries.
It potentially does. It could redefine risk, redefine opportunity for any company relying on that kind of public funding. And Intel shares reacted predictably, dropping 7%.
A lot to digest there. So, okay, looking ahead, what does this all mean for you, the listener, short term?
Short term, expect more of the same, probably. Continued consolidation, maybe some choppy trading. Definitely volatility as everyone waits for Powell's actual speech and digests this policy news.
Right, stay buckled up for a bit. And a longer view, late 2025 into 2026.
The consensus from the sources we looked at points towards a global slowdown, but importantly, not a full-blown recession.
Okay, slow down, not crash.
Yeah.
Any numbers on that?
The IMF, for example, is still projecting global growth around 3.0% for 2025. So growth, but slower.
And how does that change the investment landscape?
It likely means a big shift in themes, moving away from that rally led by just a few mega-cap tech stocks.
The really narrow rally we saw.
Exactly. Towards a market that's more diversified, more focused on actual company fundamentals, earnings, value.
So less hype, more substance.
That seems to be the idea. Sources suggest focusing on what they call AI enablers, adopters, and adapters. Companies genuinely using AI effectively, not just talking about it. And also looking at attractively priced stocks with positive earnings revisions. Healthcare came up as an example there.
Okay, so summing up, the market seems to be in a major transition, moving past the sort of abstract AI euphoria.
Yeah, away from the pure hype phase.
And towards a more cautious approach where actual results, actual fundamentals really matter again.
Absolutely. And this raises a really important question for you listening. It strongly suggests a need to rethink strategy. Well, thinking about a more diversified portfolio seems key. Maybe looking beyond just the high-flying tech names to sectors showing real tangible value and earnings resilience. That's likely essential for navigating what comes next.
So the final thought we want to leave you with is this. In a market that's increasingly demanding proof, real, tangible returns, how will you adapt your own understanding of where growth and opportunity truly lie?
Something to chew on.
Definitely. We'll leave it there for this deep dive.